Good morning, trading family. Wild card here. Saturday, June 6th, Worcester, Massachusetts. Fruit punch. Rockstar on the desk. DFV. The orange kitten asleep on my shoulder. If you're staring at a red portfolio this morning, take a breath. Let me drop the raw numbers, and then we'll get into what it all means. The SPY closed the week sharply lower. The Qs landed sharply lower. The VIX ripped from 16 to 21.5 in 5 sessions. A 35% fear spike. Bitcoin went from $71,000 to $60,000, down 15%, erasing its gains to levels we last saw in October. Gold, the safe haven trade, was down on the week, a notable decline that caught many off guard. Among the mega names, Microsoft, ticker MSFT, fell 3.13%. Palantir, ticker PLTR, dropped 5.1%. Micron Technology, ticker MU, shed 13.74%. And then you had Meta getting hammered on an unconfirmed report that they might raise tens of billions of dollars for artificial intelligence. And the moment that flipped the whole narrative, Dallas Fed President Logan said, the Fed may need to hike rates this year. Prediction markets immediately hit a 52% chance of a hike. Not a cut. A hike. This week, the market looked at reality and it flinched. TB, get in here. What did your system see?
It saw a regime shift before the headline hit. The jobs report on Friday was the loudest number, but the cracks started on Tuesday. I'll open up the macro bomb and then we'll connect it to the tech wreck. Quick reminder, nothing we say here is financial advice. Always do your own research before making any trades. The non-farm payrolls came in at 254,000 versus an expectation of 140,000. That's a full standard deviation beat. Unemployment fell to 4.1%. Friday afternoon, Logan said out loud what markets had been whispering: the next move could be a hike. And the betting markets flipped to a coin toss. 52% probability of a hike before year-end. For 5 months, the entire market was positioned for lower rates. Every portfolio, every narrative, every trade assumed the Fed would cut eventually. That assumption didn't just get tested Friday. It got repriced in a single session. The VIX going from 16 to 21.5 is the sound of the market suddenly having to price in a whole new uncertainty. That's not a small volatility adjustment. That's the market repricing an entire macro thesis. What worries me is the speed. It wasn't a gradual shift. It was a spike after one report. That tells you positioning was both extreme and crowded. When everyone's on the same side of the boat and someone yells, they all move at once. That's Friday. Wild card. You were already flagging the KOSP. I unwind on Tuesday. I want you to touch that, because that was the first crack in the dam before anyone in New York had their coffee.
I appreciate that, TV. And you're right. The KOSP, I unwind, started 3 days before the jobs report. I was watching Korean equities sell off while we were still buying tech, hand over fist here. By Thursday, I told you a forced selling cascade was setting up. Gold was dropping, the dollar was firming, and the market was ignoring it because tech was still holding. Then Friday, the jobs number gave the all clear for the whole liquidation to accelerate. That sequence matters because if you just look at Friday's headline, you miss that the liquidity drain was already underway. KOSP. I was the canary. The jobs report was the hammer. The unwind started in Seoul, not in Washington. Now let me answer the big question. Do I believe the Fed actually hikes? If we get one more hot CPI print, one more, they can't talk their way out of it. A hike becomes real. If the next inflation number comes in line, they hold, they don't cut. But the hike narrative gets priced out as fast as it priced in. Either way, they'll lower rates eventually. Thesis is damaged. Not dead, but badly bruised. And the VIX premium is telling you the market's bracing for more. TB, that macro shift didn't happen in a vacuum. It landed right on top of an already exhausted artificial intelligence trade. Walk us into Act 2.
Exactly. The tech reckoning is Act 2. and it's all about the artificial intelligence capital expenditure exhaustion. 3 data points from this week tell the story. First, the Meta stock offering rumor. The Financial Times reported Meta could raise tens of billions to fund artificial intelligence spending. Meta never confirmed it. Didn't matter. The market sold first and asked questions later. The signal here is brutal. Spending more on artificial intelligence used to be the most bullish thing a company could say. Now it's a red flag. The narrative flipped in a matter of days. Second, the Google SpaceX deal. $920 million a month for 32 months. That's $29.4 billion fixed commitment. In a world where rates might go up, that fixed cost suddenly looks like a liability, not a flex. I believe this deal will be Exhibit A in 6 months when everyone's asking when the artificial intelligence Capex bubble peaked. This week. That number. Third, Microsoft, down 3.13% on the week. This is the company with the most actual artificial intelligence revenue, not promises, real revenue. And it still got punished. If Microsoft can't hold in this environment, no artificial intelligence name is safe. The market is now asking for proof, not pledges. My system screened 328 signals across the entire week. It took zero entries. The machine looked at every setup and said there's nothing to buy right now. That's not pessimism, that's pattern recognition. The thing that would have triggered a buy a month ago was blocked this week because the volatility rate of change was already elevated. The profile shifted. Now here's where I want to push you, wild card. Is this artificial intelligence Capex exhaustion a structural shift, or is it a buying opportunity?
It's both, and knowing which names are which is the whole game. The next 3 to 6 months are structural for the hype names. The companies that have been trading on artificial intelligence buzz without revenue. Those names can get cut in half, and they deserve it. But for the companies with actual revenue streams, Microsoft, Amazon, Google, even Broadcom, the demand isn't going away. The Google SpaceX deal being $29 billion is insane, but it's also real. Companies are actually buying this compute. The market just lost patience with the timeline. My read is that the structural correction punishes the story stocks, but it creates a buying opportunity in the revenue names once the selling exhausts. Both narratives are true. The key is not treating every artificial intelligence ticker the same. That'll separate the winners and losers over the summer. And speaking of a catalyst that could rewrite the script, Tuesday's WWDC is enormous. Tim Cook's last developer conference as CEO. Apple's artificial intelligence legacy on the line. If Apple comes out with something real, something that works, it could pause this tech sell-off. If they fumble, the sector has another leg down. I'll be watching that keynote with my coffee Tuesday morning. This is the most important Apple event in years. Now let's get to Act 3, the liquidity event and the portfolio check. Because I want to show the audience what this week actually looks like inside a real book. TB, you flagged that my KOSP, I Canary set the table. Let me walk it through. Monday morning, I was flat to up. Tuesday, I watched KOSP. I start unwinding, and it didn't sit right. Wednesday, I saw forced selling patterns forming. Thursday, I told the audience, there was a cascade building. Gold was dropping alongside stocks, the dollar was firming, and the market was pretending it didn't matter. Friday, the jobs report ripped the cover off, and suddenly everyone saw it. The nothing works evidence. Gold also fell while stocks sank. Bitcoin down 15%. Safe havens and risk assets falling together is the classic signature of forced liquidations. Someone somewhere was selling everything to meet margin calls. That's not a fundamental downgrade of gold. That's a cash call. And now I'm going to get real about my own TFT book, because transparency matters. I have 11 open positions, total unrealized loss, just over $4,200. Let me name them. Broadcom, ticker, AVGO. My entry was $484. It closed the week at $385.71, a more than 20% hit. My system stop is at $435, which is above current price. The model says this is market noise, not thesis failure, so I'm holding. Enphase Energy, ticker ENPH. Entry at $68, now at $56.07, down 18%. Stop is at $54.16. That stop is going to get tested early next week. If it hits, it hits. The system knows the number. Advanced Micro Devices, ticker AMD. My entry was well above the current price, currently down approximately 11%. My stop is set just below the current level. Amazon, ticker AMZN. Entry $258, now $246.47. Stop at $240. Alphabet, ticker GOOGL. My entry was higher, currently down, and my stop is set below. Apple, ticker AAPL. My entry was higher, currently down slightly, with a stop set below. Every single one of these positions has a stop. Every stop was set the day the trade opened based on math, not vibes. The hardest thing about a week like this is not the loss itself. It's sitting in the gap between current price and your stop. That's where traders break. They panic sell on a Saturday, mentally exiting positions they can't even trade. The system decides. TB, your book is a museum of everything that worked this year, and you're sitting on 24 of 25 positions red. What's the machine telling you?
It's telling me the profile changed and it's not done. I've got names like Wolf, ticker WOLF, down 17.74% on the week, now at $55.15. That one was entered way higher. The stop is way down at $39. That stop is crash insurance, not risk management at this point. If Wolf hits 39, we're in a completely different market. Nuscale Power, ticker SMR, down 12.46% to $10.50. D-Wave Quantum, ticker QB, TS, down 14.97%. All speculative artificial intelligence and quantum names getting wrecked. The lone green position in my book is Kohl's, ticker KSS, up 3.23% on the week at $15.45. Discount retail holding green, while semis and quantum names get crushed. That's not a random blip. That's a rotation into staples and away from growth. The market is screaming at us what regime we just entered. The machine saw the volatility profile change and locked out every entry at 0 of 328. That's the discipline. The human would have tried to buy the dip Wednesday. The machine said no. And now we sit and let the stops work.
That's the lesson. Pure liquidity events you can buy because the companies didn't change. Pure fundamental repricing you can analyze and adjust. But when both hit at the same time, your signals cross. The price action says sell, but your conviction says hold. Conviction is the first thing a margin call eats for breakfast. The only defense is a system with preset stops, and then the discipline to sit on your hands over a red weekend. So let me pivot to what we're watching next week. Monday's VIX Open is critical. If the VIX gaps above 22 and stays there, we're in a new volatility regime. And any bounces are sells into strength. If it opens below 19, we might get a relief rally, but I'd still be selling into it. Neither scenario says buy the dip with both fists. Tuesday through Wednesday, the WWDC keynote. Apple's artificial intelligence story will either stabilize the tech trade or accelerate the rotation. It's the single biggest narrative swing point of the week. Beyond that, the next consumer price index print looms. One more hot number and a Fed hike becomes real, not just a tail risk. And we'll keep watching KOSPI on Sunday night for any continuation of the forced selling cascade. That unwind may not be finished. TB, take us home.
Here's the truth. Saturday morning, portfolios are red, and the mind runs scenarios. You start planning what you'll sell Monday. You rehearse the conversation with yourself about whether to take the loss or wait. I've been there. Everyone listening has been there. But your anxiety between now and Monday at 9:30 Eastern, it changes nothing. It just makes your weekend worse. Your system, whether it's an algorithm or a set of rules you wrote on a piece of tape stuck to your monitor, was built for days like this. If you have stops, trust them. If you don't have stops, Monday morning is too late to add them. So here's your assignment. Close the laptop. Go outside. Touch actual grass. Be with people who don't know what a VIX is. The market will still be there Monday, and you'll be better at trading it if you show up rested instead of having spent the whole weekend in the red. This was a real week, but it was 1 week. The market doesn't end on a Friday. Wild card out.